Hello and welcome to another episode of New Retirement Thinking. My name is Sumay Zake. Today we're looking at a seemingly growingly popular alternative investment method, hedge funds. What are these and in what ways could you leverage them for retirement? We have an expert on the topic to help us learn more about the world of hedge funds. Joining me in studio is Marilyn, Ramplin, CEO and founder of Hedge Fund Academy. Marilyn, thank you so much for your time.
Thank you.
So someone says to me, Sumay, we're planning for retirement. They say we're going to look at hedge funds. I freak out. You're going to make it simple for me.
Absolutely. So the big question people always ask is, what is a hedge fund? And I think the easiest way to understand it is if you look at your traditional investments that we have, your unit trust. When you invest into a unit trust, the manager would normally buy an underlying equity or a bond, and they would hold it and hope and pray that the market goes up. If the market goes down, you would be exposed to risk in that particular investment. What a hedge fund tries to do is to say, how do you make money when the market goes up, but also make money potentially when the market goes down, or how do you build in protection into your underlying portfolio against the market going down? And that's one of the biggest benefits in terms of hedge funds looking at it from a risk point of view. How do you manage the risk in your portfolio? And this is one way of actually doing it.
Is there, two quick questions come to my mind. Is there an increasing use of hedge funds in people's retirement portfolios?
Absolutely. So what you find with, from a regulatory perspective, the regulators under Regulation 28, which is the pension fund regulation in South Africa, actually now allows pension funds to use hedge funds in their portfolio, and you can now actually put up to 10% of your assets into hedge fund portfolios. Now, it's still a very small part of most pension funds portfolios, but it is definitely growing. The other part of the puzzle here is that there's a new framework that's been created that now allows not just high net worth individuals, but also retail individuals the opportunity to be able to go out and buy hedge fund investments for their portfolios.
So fine, the framework is there, but the thinking still is that when you talk about hedge funds, you're talking about high net worth individuals. Debunk that myth for us. Absolutely.
So up until now, hedge funds had a very high minimum entry level. You had to have like a minimum of
and
R1 million.
It was a barrier to entry, basically.
Absolutely. You had to have a million rand minimum investment to put into the portfolio, which kept a lot of us out of hedge funds, for example. So now you have hedge funds that are being created where the managers have absolutely no limit. They can decide on what that limit should be in terms of how much money you can now put into a retail hedge fund. So you now have the option to be able to, if a manager says 5,000 Rand minimum investment, to now go and enter into a hedge fund portfolio.
How are South African hedge funds managed when you compare them to offshore hedge funds?
So my background is I come from a hedge fund trading background, and I used to work in New York and London for about 15 years, sort of in the hedge fund space. So when I look back at what we used to do from a hedge fund perspective, I think our strategies from a South Africa perspective are very vanilla. So what that means is that they are a lot more simple in terms of understanding them, and they're not as risky as some of the portfolios that are implemented internationally. But in terms of what they're trying to achieve, the outcomes are definitely there.
And if we look at the various characteristics of hedge funds, can you give us a few so that our viewers out there know what to look out for?
So some of the main differences, as I said, hedge funds look at how do you make money from the market going up and the market going down. So what you find in typical hedge fund strategies is, one, they will have long positions. Two, they will have short positions, which is where they make money on the position going down. And three, they would use leverage on those positions that they believe that they have a strong conviction in on the upside, and therefore they would lever those positions up. And some of the funds could also use derivatives, and therefore when you look at the characteristics of a hedge fund, it's often very difficult to define a hedge fund in terms of, this is a hedge fund, but it's easier, as you said, to look at the characteristics. But therefore, when investors look at it, they must then also do their homework in terms of the underlying managers that they will be giving to in terms of how they implement the strategies.
When you look at advisors, one's financial advisors, certainly my advisor, and I won't mention who they are, doesn't bring up the hedge fund discussion. Why is that?
I think there is a lot of education that needs to take place with the actual advisors in terms of the benefits of hedge funds in portfolios. Because hedge funds have not been open to retail investors up until now, I believe that advisors weren't as keen to recommend these underlying strategies to investors. Now you have a framework that says the risk within a hedge fund portfolio for a retail investor has been managed through a regulatory framework that dictates to the manager how much risk you can take in the portfolio, and therefore advisors should now be in a better way to be able to judge the risk within a certain portfolio that they can now recommend to their underlying investors. But there's definitely an education element to getting advisors up to a certain level.
Marilyn, leave it there for now. Do stay with us after the break. We're going to continue this discussion. Welcome back. This is New Retirement Thinking. I'm Samay Zake. With me in studio is Marilyn Ramplin. She is CEO and founder of Hedge Fund Academy. And you guessed it, we are talking hedge funds. So, Marilyn, just before the break, we were talking about education. And I want to pick up on that topic in particular when we look at what the industry is doing when it comes to trustees and making sure that we can get this message out that these things are frightening, but sure, you can include them in your portfolios.
Sure. So education, in my mind, is an important element of, one, how you get people to dispel some of the myths around hedge funds, but two, also get people to understand the benefits of potentially putting a hedge fund into your portfolio in order to be able to manage some of the downside risk. So if you look at traditionally, pension funds are not looking to shoot the lights out. Pension funds have a portfolio where they need to manage their assets versus their liabilities. And what hedge funds try to do, in a way, is to look at how do you create a framework that will manage the risk on the downside and give some capital protection. So when you look at trustees, for example, that's where the education needs to start in terms of looking at how does this underlying strategy actually fit into my portfolio in order to be able to give me what I'm looking for in terms of being a trustee of my portfolio. Then if you look at specifically the retirement industry, we rely very heavily on consultants in the industry, and therefore the consultants would be another part of the stakeholder puzzle that we would have to get up the curve in terms of understanding of the recommendations that they would have to make to their underlying pension funds of how they would invest their money. Is this the be-all and end-all in terms of managing the risk in your portfolios? Absolutely not. It is a part of your portfolio around how you can allocate assets, where you could look at leveraging your 10% that Regulation 28 gives you. If you look on the IFA side, I think the education there is more on understanding different strategies, understanding different due diligence processes to be followed from a manager perspective, and actually understanding the risk and finding out, is this the right strategy for the underlying client that I'm looking for. So we actually offer a lot of those programs for trustees, for IFAs, and even for managers, looking at how could I actually create an additional offering for my clients where I am already managing pension fund money.
All right, so that's the industry. We've covered that in great detail. We're happy that's sorted. The individual, what sort of education is there for them? Because I'm never going to come to my advisor and say, hey, Mr. Advisor, let's talk about hedge funds.
Yeah.
One, because the education, as you've rightly said, is not there.
Yeah.
So what needs to be done, or what is being done? What's the Hedge Fund Academy, which you represent, do to address that?
Absolutely. So we actually offer programs around hedge funds. What are hedge funds? How do they fit into portfolios for individuals as well? But I think as an individual, you still need to look at this in the context of your portfolio. You need to look at it in the context of your life stage. Where are you in your life stage? And I would always recommend that if you are an individual, find an advisor who understands hedge funds. And one of the best places sometimes to start is, if you're not sure to find an advisor, is to go to a manager who manages hedge fund portfolios. If you want to talk specifically maybe about implementing a strategy, etc., they can then help you to look at how that could potentially be done. But from an individual perspective, you need to understand the risk in hedge funds.
Yeah.
So hedge funds use leverage, and therefore you have a greater exposure to the market than what you started with in terms of the investment in the fund. They use short positions. So these are the things we try and teach the individual to understand, get them to get comfortable with it. And when they do their due diligence on who they will give their money to, they need to be able to ask the right questions around how those risks are being managed and the manager's experience of managing those type of strategies in their portfolios.
Fees. That's the one thing that we go on about on this show when it comes to retirement planning, because that eats into your investment. How expensive is it to run these things?
Okay, I'll tell you exactly. Most of them charge about 1% management fee, and then there is a 20% performance fee. Now, the interesting thing about hedge funds, which most people don't know, is that hedge funds charge fees on what's known as an absolute performance basis. What that means is that they will charge you when your return is above zero, they will charge you a performance fee. But that performance fee is then also subject to a minimum level of performance that you must achieve in your fund. So let's say the hurdle rate in the fund is 10, you will only start paying performance fee once it gets to plus 10. So the difference between 10 and whatever the outperformance was, for example. If you look at traditional portfolios where they charge performance fees, which most pension funds may actually have some form of arrangement in terms of their portfolio, some of them could be charging on a relative basis. That means that if you have a benchmark that a benchmark that may have underperformed, so it's let's say the benchmark returned minus 20, the fund returned minus 10, you would still potentially have to pay a performance fee on the outperformance of the minus 20. So in fact, there is a benefit from a fee perspective when you look at hedge funds, given their absolute return strategies.
Okay, I've got about 10 seconds. I'm going to give that to you to bust one myth about the hedge fund industry when it comes to retirement. Go.
The fact that hedge funds actually bring a lot of risk to your portfolio. If you look at the risk-adjusted returns of hedge funds, in fact, what they do is they lower the volatility in your overall portfolio for that strategy, and therefore you have to take a lower level of risk for a certain level of outcome.
Good place to leave it. Thank you. That is Marilyn Ramplin. She is CEO and founder of Hedge Fund Academy. Till next time, goodbye.